Welcome to Oregon Cash Flow Pro. My name is James Barber. I'm here to help you maximize your cash flow. In today's video, we're going to talk about MECs. What is a MEC? What's the MEC limit? What does that mean to you? Why you should know about it? What happens if your life insurance policy turns into a modified endowment contract? So if you're on the hunt for a high cash value life insurance policy, you're going to want to stick around and learn what a MEC is and how and why to avoid it. So here we go. First, what is a MEC? MEC stands for Modified Endowment Contract. This is relevant when you're looking for life insurance, because if you have a life insurance contract that starts out as life insurance and you fund it at too high of a level, it can turn into what the government recognizes as a modified endowment contract instead of a life insurance contract. And that can have severe consequences depending on how you're trying to use your policy. So let's take a quick look from an Allianz illustration at what it describes as the taxation of life insurance and what becoming a modified endowment contract does. There's a lot of good information in a life insurance illustration. Chief among them is a lot of warnings about things you should be aware of. In this case, it highlights the Guideline premium test and the cash value accumulation test. These are the two main tests that determine how much money you can put into a life insurance policy in any given year without going over the MEC limit. I really want to highlight this warning right here. Failure to qualify as life insurance will have adverse tax consequences. And we can see what that means down here. In order to receive favorable federal tax treatments on distributions, also called loans, the total premiums you pay into a policy must satisfy the 7-pay premium limitation. It also has to satisfy the Guideline premium test or the cash value accumulation test. Otherwise, your policy could be considered a modified endowment contract, or what we call a MEC. Making policy changes that are material changes or reductions in benefits can also result in your policy becoming a MEC. So what those two things mean: the 7-pay premium limitation is how much money you can put into the policy in the first 7 years. The policy changes that can be considered material or reductions in benefits that might also result in the policy becoming a MEC are changes and reductions typically in the death benefit or in how much premium you're putting into the policy. Those two things can adjust where that MEC limit is at. And depending on how much you've funded your policy, it could trigger a modified endowment contract. If the payment of any premium will cause your policy to become a modified endowment contract, insurance companies will let you know. I don't know of a single one that won't. Basically, they will all give you a warning or reject your payment or alert you to the fact that your policy is at risk of becoming a modified endowment contract. At which point you will have the choice to continue making that premium payment and allow your policy to become a MEC, or to withdraw the amount you put in and reduce the amount of your payment. If you take a distribution from a modified endowment contract, this is where you're going to feel the effects of the change. They have to change the distribution from a first in, first out distribution policy, which is how life insurance is normally treated. You normally get to take out the basis, the money you've put into it first, comes out first. And so you can access it as a withdrawal with no tax consequences. Under a modified endowment contract, it changes and they have to distribute the gains or any interest you've earned first. Interest is taxed as ordinary income in this circumstance. In addition, if you're under age 59 and a half, there's an additional 10% federal tax penalty, just like you would see when you take a premature distribution in a retirement vehicle, because these policies are very similar to retirement vehicles in that they grow tax deferred. And as long as you access them in the approved way, meaning as life insurance and not as a modified endowment contract, you can access it tax-free and without any penalties. But if it becomes a MEC, now we're going to have some penalties we're typically not going to want that. Now, there are some circumstances where people may not care if they create a modified endowment contract, and that might be a circumstance where they're looking at this life insurance policy strictly as a death benefit to pay out down the road. Even with a modified endowment contract, the death benefit gets paid out tax-free. You just can't access it without having any adverse tax consequences. So if you have no interest in touching it, you can certainly fund it at a higher level and not have to worry about it becoming a modified endowment contract. If you're planning on taking income from your life insurance policy at some point down the road, you got to watch out for those limits, and we're going to make sure to stay under them. I mentioned two different ways that the MEC limits are measured, and that's using the guideline premium test and the cash value accumulation test. The cash value accumulation test provides a little more flexibility in the very early years of the policy to where you can put in more money compared to the death benefit than if you're using the guideline premium test. So there are some agents out there that will design your policy to meet that cash value accumulation test. The thing to watch out for when we use that cash value accumulation test, also called the CVAT test, is it does require a higher amount of death benefit throughout the life of the policy. So it ends up being less efficient in the long run when it comes to creating cash growth in the policy and the ability to pull out more income down the road. So what I like to use and what I usually recommend is the guideline premium test. The guideline premium test is also known as the guideline level premium. When you're looking at your illustrations, you're typically going to see guideline level premium somewhere in there. That is the maximum amount that you can contribute on average every year in your policy. Now, I got to be careful to say on average, because some years you might end up paying less into the policy, and other years you can actually catch up on those payments. And the rules around that are going to depend on which insurance carrier you're working with. But for the most part, let's say if your guideline level premium is $10,000 a year, that means in year 5, you were able to contribute up to $50,000. That's $10,000 for each year. If you've put in $10,000 each year, you are at your limit. If you put in less than $10,000 in any of those years, by year 5, you can catch up all the way up to that $50,000, as long as the average for every year in your policy is below that guideline level premium limit, which is our MEC limit in this case. Now, the alternative MEC limit, if you're only going to fund a policy for just a few years, we do have that 7-pay premium limitation. That 7-pay premium limitation can often be higher than the guideline level premium. And if that's the case, that means you can fund it at a little bit higher level in the first few years. But what we're going to see happen is if you continue to fund it at a high level, they're going to reduce how much you can put in year 4 or 5 so that your average doesn't surpass that guideline level premium. Case in point, if your 7-pay premium was, say, $15,000 a year, and your guideline level premium is $10,000 a year, you could probably put in $15,000 a year for the first 4 years. But then in the 5th year, you wouldn't be able to put anything in because your average is going to have to come down to be $10,000 a year. Now, it's also possible if you only paid money in for 7 years, you could do $15,000 for each of those 7 years. So it gets a little bit complicated. This is where your insurance agent is going to help you. They're going to hopefully design it to the best of their ability to meet what your requirements are and keep it being the most efficient. But my goal here is to teach you what to look for so that you can help hold them accountable, because the reality is not all insurance agents know this stuff. Oftentimes, the organizations that they work for will just give them a script to use and push them out the door to go talk to you, the client. And if they have any questions, they're going to have to reach back and talk to the home office. So be sure to check out all of my other videos on life insurance, whole life, IULs, infinite banking, so that you can be empowered to make sure that you're getting the best representation from your agent. And if you want to talk to me or you want a second opinion, you've got an illustration you'd like me to take a look at, feel free to sign up for a one-on-one consultation with me The link is right here. I'm happy to talk with you. In the meantime, now you know what a modified endowment contract is. Now you know what the MEC limit is. And just know that typically, when it comes to designing a policy for your optimum benefit, that MEC limit should be just over however much you're trying to contribute into your policy. That way you can be max funding your policies. By max funding your policies this way, you're able to put in the most amount of money above the cost of insurance in it and turn it into a wonderful tool for helping to build and sustain your financial wealth. So I hope that helps. And if you're interested in more information on life insurance, check out these videos right over here.
Now go maximize your cash flow.